Welcome back. Well, let's get talking to another pharmaceutical company now. We have Strides Pharma Science, which is the next management on the show. Revenue has grown by around 14%. Growth was led by strong performance in the US, new launches and efficient execution as per the management. We have Arun Kumar, who's the founder and the non-executive chairperson of Strides, joining in now. Mr. Kumar, good to see you in. Welcome to the show. Well, if you could just start by talking about the FY26 guidance, because you have met FY25 guidance. What are you now projecting for FY26, say, when it comes to revenue, when it comes to your EBITDA, as well as your debt to EBITDA and US markets?
Hi, Ekta. Thanks for having me on your show. We actually as a company don't give guidance, but we had quite some turbulent times in the last 3 years. So we guided to an extent where we wanted to be sure that we were executing right. And in the last call, we decided that we would not provide a guidance. But we have had a strong FY25. We are very confident that we'll grow from there, both on revenue and EBITDA. And our focus is obviously the balance sheet, where we believe that our strong cash flow generation that we had this year can be replicated, further deleveraging. At this time, we are very comfortable on the strength of our balance sheet, the fact that we have reduced our debt from a high of five times to under 1.9. And I think we've got lots of headroom to even grow the business from here based on the strong operating cash. I think our exit run rates would be a good base to set targets for the going forward years. And a larger outlook that we have to achieve a 400 million sale in FY27-28 in the US is on track. It's overall been a great year, a great comeback year, a fantastic teamwork, and we've delivered on everything we said we would. And I think we'll continue growing from there.
Okay, so I just want to narrow down on this $400 million by FY27, FY28 in the US. What is that predicated on? How many products are you looking to launch? You have, plans of reintroducing 60 products, which are dormant at this point in time. But would it primarily be led by generic drugs, or do you see some opportunity in terms of exclusivity, etc.?
So we have two parts of our US business. The first part, obviously, is our niche products in the generic space. More than 40 of our 70 products that are launched in the US, we are market leaders for many years. There's very little competition in these programs because they are either hard to make or hard to get APIs. That will lead us to get to the 400 million target that we have set for ourselves. This, obviously, as you rightly pointed out, would be from our library of products. We now have about 260 plus ANDAs. We have only commercialized 70 of them. And while we lose some market share in products, as is the case in the US business, we'll continue to add new programs and new products to get to the 400 million. So we're kind of fully ready for the 400 million in terms of portfolio. We have launched 5 to 6 products in the last year from the old portfolio, and we are very measured in terms of timing and pricing. So we wait for the right opportunity to get our products launched. But we've now, since the last 2 or 3 quarters, been talking about what after the 400 million generics play in the US. We've called something called Beyond Generics. And Beyond Generics is really addressing your question, is more to 505(b)(2)s in specialty pharma. Our first product was filed in that program, and they are mainly controlled substance drugs in different domains and formats, which only our New York facility can produce. And that, again, is a very specialized area which we are very focusing on. So it's nasal sprays and 505(b)(2)s.
So let's take that further itself. Your exit run rate in the fourth quarter was close to around $330 million in the US. Do you think that that is a level that one can expect in FY26 before you move to FY27, FY28 and get to that $100 million per quarter sort of run rate in the US? And beyond generics, beyond $400 million, do you have an aspirational target here, say by FY30, FY32? Are we looking at $1 billion?
Our 400 million story is based on niche average revenues of $5 to $7 million per product. We work on the low end of the value chain, which is very attractive for us. And we think we have everything that's required to get us there in place. On the beyond 400, typically our average product filing size is between $25 and $50 million of revenue goals. So it's a very significant shift in our strategic play in the US. And they're obviously more exclusive developments. And like I said, they're mostly 505B2s. And there we haven't put a revenue number as yet. But what we're doing is will almost be 5 ANDAs equivalent to one product that we have in the beyond 500, 400 play. So yeah, it's completely differentiated between.
How many products are you eyeing then, if you can back calculate that?
Well, I think we would have a portfolio of over 25 products. Not everything will be very successful, but they're very expensive developments. Each of these developments are significantly higher than a regular ANDA. So yeah, so I think you'll see that playing through in the next 12, 14 months when we expect to receive our first product approval in that space.
All right. Arun, you're mentioning the US markets. You've been looking at the US markets for years now, from different administrations. And now you're working with the possibility of tariffs coming through, onshore manufacturing being encouraged. I heard you mention a New York facility as well. So take us through where you stand when it comes to the entire situation in the US on tariffs as well as onshore manufacturing.
Yeah, so Ekta, manufacturing high volume generic prescription products is not feasible in the US. That's not going to happen. It has to be significantly higher, high-end products. Cost of manufacturing is between 3.5 to 4 times more than Asian manufacturing. So to assume that generics can be onshored overnight, unless supported by very significant subsidies or a capital allocation from the government, the US government, I don't think you'll see a lot of generic products moving into the US. It's just not practical unless the market is willing to accept a much higher price. At the same time, there are very nice niche businesses that require US manufacturing, and therefore our US plant in New York kind of fits that segue very well. And we are excited about that operation because we've now crossed over $100 million of revenues from that plant, which also means that producing in the US makes sense. But then the limitation is the portfolio, the type of products, and typically they have to be products which are not necessarily generics, but has to have something generic plus. So I think there's a lot to wait to play out. My personal belief is that generics will not get severely impacted by tariffs, but it's a very hard call to take in with the ambiguity in the geopolitical situation, especially with tariffs. I think the next 90 days will be crucial when everything settles down. For us personally, as a company, we have been a contrarian play forever. We solidly believe in the US opportunity, and they've been growing nicely and roundly in that market. I'm sure that if tariffs hit our business, there are opportunities for us to absorb some costs, but not impacting our financial goals. And the rest will have to, unfortunately, be passed on to consumers. But that's what I think most companies will have to do, end up doing that.
You want to give a quick one on your margins and your net debt as well? Because I remember, at some point the margins did touch that 20% mark as well, were a multi-quarter high. Thereafter, you said they were sustainable. They're meandering just a little below that 20% mark. And with the kind of launches...
So don't forget that these numbers are adjusted for a very high margin soft gelatin business, which was carved out into one source. And that's what obviously delivered the $900 million of value creation to the Strides shareholders. We are very confident of getting to the 20% even in our base business. But it's a process of time. We still have some work to do on our operational costs or under recoveries, which is standard. Network optimization stuff all of us in the generic industry do live by day in and day out. I'm very confident that we'll be closer to the 20% in FY26.
All right, Arun, we're going to leave it on that note. Thanks very much for joining in and giving us your perspective on Strides. So that's
Thank you both.
the stock. 723 odd rupees, down around 1% odd. We'll take a short break. But here is some good news for our viewers. India's business news leader is now a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.